Hello. In this video, we'll continue with our gross income set of problems. This is problem number 6. Now, Kiwi is going to receive the following items from her employer during the year, and we need to determine if these amounts are in gross income. And remember, whenever you have any type of income tax issue, you should always ask what amount of income is there, if any, what amount of deductions or credits, so income being inflow, deduction credits being outflow, so those are the first two questions. And then from there, you say, when do those items become reported, who has to report them, and what is the character? Now we're going to focus on the what amount of income, if any, the when is it recorded, and the who has to record it. Those are the three questions we're really going to focus on. And remember that gross income is defined from tax purposes under Code Section 61 very broadly as any income or any amount of income from whatever source derived, or all income from whatever source derived. Since the definition is so broad of gross income, and there really isn't an articulated definition, we have to focus on Glenshaw Glass, the Supreme Court case. And in Glenshaw Glass, the Supreme Court stated that there must be an undeniable accession to wealth, which is clearly realized, and which the taxpayer has dominion and control. So the first thing is that the accession to wealth, there must be an accession to wealth, which is net worth increasing. The second is that there must be a realization event, which is where there is a severance between the items. And the third is dominion and control, which I call D&C, which deals with there's no strings attached to the amount. So the first is $40,000 in wages. So $40,000 that Kiwi actually earns and gets that money, whether it's after tax or whatnot. The question is that gross income? So has Kiwi's net worth gone up? Well, before the beginning of the year, Kiwi didn't have the money, and after the end of the year, yes, because again, we're looking at before versus at the end, because you're looking at the tax return period, which is during Kiwi's tax return year, which Kiwi is almost surely, since it's an individual, a calendar year taxpayer. So at the beginning of the year, didn't have the $40,000 wages. After, had the $40,000 wages, which is cash. So therefore, assets have gone up. So net worth increases. Because remember, net worth is assets minus liabilities. Our assets have gone up, and therefore our net worth has gone up. The next is realization. Well, this is services. Kiwi is performing services and getting wages. Kiwi is an employee performing services. Therefore, remember, realization. Whenever there's services, automatically realization event. And finally, are there any dominion control issues? No, we're not told that Kiwi is restricted in terms of actually getting the funds or not getting the funds or whatnot. So dominion control is not an issue. So therefore, all $40,000 is included. And by the way, that's the language we use when we talk about gross income. We include or exclude gross income from the tax return. So all $40,000 is included in this same year, and during this year is included to Kiwi. All $40,000 is included to Kiwi. The next item is a $2,000 as a holiday bonus based on a percentage of employers' profits. So Kiwi's getting an end-of-the-year bonus for a great year, and sometimes it's referred to as a holiday bonus because, well, it's around the holiday season. So really, if we go through the same analysis, net worth goes up because before we didn't have the $2,000. After the end of the year, we do. Realization, again, this is based on services. Yes, it's a percentage of employers' profits, but it still comes from Kiwi's actual services. So the first item, our net worth has gone up. That's met. Second, realization, it comes from the services. Yeah, it's, again, from employers' profits, but it wouldn't have been given based on how hard Kiwi worked. So that is from services. And finally, number 3, dominion and control. Are there any restrictions here? No, there's no restrictions. Therefore, we have all 3 items, and therefore, all $2,000 is included to Kiwi in gross income that year. Again, included means it goes actually on gross income on the tax return, goes into the amount. So far we have 40 plus 2, 42,000 for Kiwi in terms of the total items. The next item was spiral ham with a fair market value of $50 as a holiday gift for her family. So this is something that some companies do. It used to be a more common back in the old days. Well, the companies would send out or give their employees a ham for their family, just as a holiday gift, and then the family would eat that during the holiday season. The question is that gross income? Well, again, if we go through our definition, is a ham an asset? Well, it is a benefit. An asset is an economic benefit that has value. And yes, the assets have gone up. So before we didn't have the ham, after we do, so assets go up, so therefore we have net worth increase. Realization. Again, why is Kiwi getting this ham? Well, it has to do with being an employee of the business which deals with services. So again, we can say it's based from the services. Finally, number 3, are there any restrictions on the ham? Does it have to be eaten with somebody, or can it only be eaten at a certain time? Like you have to wait until next year? No, there's no restrictions. So dominion and control are met. So based on our definition of under Glenshaw Glass, this meets all 3 criteria, and it is gross income under the definition. However, the way that the tax law works is, yes, we have this definition, but as we've discussed in previous videos, where we have the distinction of economic versus financial income, and remember, tax income is a legal definition under the law, and it falls somewhere in the middle. The gross income falls somewhere in the middle because there's certain items that are excluded. From a financial accounting standpoint, this is definitely income. From an economic standpoint, this is definitely income because you have this asset. You have this item. However, with respect to the tax law, Congress went ahead and said certain de minimis items from work or fringe benefits. Certain de minimis fringe benefits, which fringe benefits are basically any type of compensation that's paid from an employer to an employee other than the actual cash. So we're talking about insurance, if there's child care provided, a cafeteria on the employer's premises, providing lodging or a car. Those are all considered fringe benefits, and there's so many different types out there. Well, there's what we call a de minimis fringe, which basically says, hey, if the employer provides the employee free coffee, one morning, or free donuts, or something like a spiral ham, it's a very low number, and there's no set number what de minimis is, but it's going to be excluded. And this would meet that criteria. A $50 spiral ham where all we look at is just this one time. So the regulations, again, there's no specifics on what is considered de minimis, but it's more about the frequency. If this spiral ham is given out every week, then $50, that can add up. That's 50 times 52 weeks. That's over $2,500. That can add up, and that actually would not be de minimis exclusion. So this is excluded. This $50 is excluded gross income. So it is not put on the tax return, or the value, I should say. Not $50 of cash. The $50 value is excluded from gross income to Kiwi because of this de minimis fringe. And again, there'll be more videos on the exclusions specifically, but I just want to talk about this. But the idea here is that this is excluded because, think about it. Think about the administrative concern. It'd be an administrative nightmare if you had to record every little thing that you got from your employer, as small little tokens, very small gifts. And another thing is, how do you value the ham? Think about honey baked ham, right? You get this ham, and how do you value it? You might have the receipt, but it can become quite a hassle if maybe the employer got them bought 1,000 of these hams for all their employees, and they didn't get them at the normal value that one individual could get it at. So that's really something to understand, is that there's administrative concern here, both on the IRS and the taxpayer, and that's why this de minimis fringe came about. And again, under the regulations, The idea is that these are things that you really can't, it's really hard to value, and also they're not really regular, because if there is regularity, then obviously taxpayers would use this rule to kind of get around the rule. So if it's just one time like this, once for the holiday, it's obvious it meets that it's not regular. And again, there is a value issue in terms of valuation. So therefore, from the administrative concern aspect, it is excluded. But again, we saw for our definition of gross income, it meets it. So this is something to take, this is a takeaway from this problem, is that if you meet these three criteria, it's still possible you might not report it on the tax return. And that's what makes tax not only complex and maze-like, but also interesting. Okay, finally the last thing is, what if Kiwi got, in addition to getting the ham and these other things, also got a $200 Honey Baked Ham gift card to celebrate New Year's. So in this example, we saw a $50 spiral ham that Kiwi actually got the ham. The other is, well, what if Kiwi just gets a $200 gift card as well to celebrate New Year's? So if we go through our analysis, our net worth goes up, right, because it's an asset. It's just like a prepaid account. It's prepaid cash to Honey Baked Ham, and a prepaid account is an asset. So our assets and minus liabilities have gone up. Realization. Do we have realization? Yes, because again, this was almost surely given by being an employee of this employee or the employer. So realization through the services. Finally, any restrictions. And again, restrictions can be, oh, you have to wait till next year, and then it would be an issue of, oh, next year. Well, there's no restriction, so it has to be taken into account this year. So there's no issues on dominion control, no strings attached. So all three are met, and we do have gross income under our definition. So right now we're thinking, okay, it's included. But we do have the de minimis fringe, because you might be saying, okay, well, a $50 spiral ham versus a $200 gift card. Well, actually, under the rules, it says that gift cards, and this is through the various authorities, various provisions out there, gift cards are one exception. And the reason is because, remember I talked about the value as well as the regularity, and those both need to be there. Gift cards can be valued. There is easy to articulate value of a gift card. It's the amount on there. And you might be thinking, oh, I can, if I get a $200 gift card from Honey Baked Ham, and I don't like Honey Baked Ham, you could probably sell that gift card on one of those gift card sites online for $150, and you get $150 cash. So it becomes a lot less easy to try to, get rid of that and get the cash. The idea here is, with cash, it's pretty obvious what the amount is to record, and from an administrative concern, it's not that big of an issue. Gift cards are somewhere in the middle between cash and the ham, the actual ham. Where the ham, again, because it's not regular, is excluded. The gift card is somewhere in the middle because, yes, it does not have exactly cash value. You can't just you can't use that Honey Baked Ham gift card to pay your utilities or pay, do whatever you want with it. But still, you might be able to sell it to someone online because, for a little bit less than the $200, maybe about $150 to $175, and you get that cash. So actually, Treasury has said, no, gift cards do not get the de minimis fringe. So there's no de minimis fringe allowed. So that means that this $200 is included to Kiwi in gross income. And again, the when question is this all same year? It was all this same year. The who is Kiwi. Kiwi has to include these. The what? So again, just to recap, the $40,000 in wages included, and it is gross income. So that's $40,000 so far, plus the $2,000 bonus, that's included. So we have $42,000. The $50 ham, the value of the ham was excluded as a de minimis fringe, even though it met our definition of our Glenshaw Glass definition. And finally, the $200 gift card is included because there's a rule that states that, okay, we have the general rule, the exception, and then the exception to the exception that says, no, gift cards, they're example of something that's not part of the de minimis fringe because the valuation is not an issue. So we have $40,000 plus $2,000, that's $42,000, plus $200,000. So $42,200 is the end answer to this question. So I hope you've learned more about how exactly we go through these things. And these are just some examples to show you where there's some exceptions to this definition of gross income, and how, again, the tax law definition, even though we have this Glenn-Shaw Glass definition, there's ways that Congress and the Treasury can carve out various items for administrative concern.